Okay, let's unpack this. If you're in India and thinking about health insurance, or maybe you already have it, get ready for some truly game-changing news. You really need to mark your calendars for September 22, 2025, because something, well, monumental is about to shift in your favor. Here's the bombshell. The goods and services tax, yeah, GST, that 18% on individual health and life insurance premiums, it's being completely removed, dropped to 0%. And this isn't just some small tweak. It means a direct premium cost reduction, probably around 10–15% on average. That's right, health insurance is actually about to become significantly more affordable. So today, we're diving deep into how this incredible development and, other crucial factors can help you competently choose a really robust health insurance plan in India. We're specifically looking at that popular 5 lakh to 10 lakh coverage range. Our mission here is to arm you with the knowledge so you feel truly protected. We want to guide you through what can be a pretty confusing landscape, right? Help you build your own personal financial fortress against those medical costs.
Exactly. And what's fascinating here is this GST reduction. It isn't just a simple discount. It's really a strategic move by the government. They want to dramatically boost health insurance penetration across India and, significantly cut down the burden of out-of-pocket healthcare spending. It just highlights the growing, frankly, critical importance of securing your health in India's healthcare landscape, which is evolving so fast. Because let's be honest, medical costs are just spiraling. We're talking medical inflation at a staggering, maybe 10–15% annually. Think about it. A single hospital stay or say a common heart surgery that can easily cost 4 to 5 lakh, maybe more. So choosing the right coverage, it's not just nice to have. It's absolutely essential for your financial security, for your peace of mind. We'll walk you through the essential categories, the key things to look for, even compare some top rated plans. We want to make sure you don't feel overwhelmed, but actually feel empowered.
Okay, so where do we even begin this journey? Finding the right coverage, well, it always starts with you, right? Your unique situation. Let's talk about the who and what of your coverage needs. When we say sum insured, just think of it like your medical safety net. It's the max amount the insurer will pay out in a policy year. Now, 5 lakh to 10 lakh is a pretty common starting point, gives meaningful protection. But here's a crucial insight. For many people, especially if you're living in a metro city like Mumbai or Delhi, maybe even Bangalore, even a 5 lakh plan might not cut it. The costs are just so high. You really have to factor in inflation and your specific location. Because, a surgery that costs X in a tier 2 city could easily cost double that in a tier 1 city. Right. Now, let's zero in on the type of plan that fits your life best. You've got several options. An individual health plan is, well, straightforward. Covers one person. Pretty ideal for young professionals, maybe unmarried individuals. Then there are family floater plans. These cover your whole family, spouse, kids, often parents too, all under one single shared sum insured.
This is generally more economical for families, yeah. But here's a heads up, a common mistake to avoid. If one family member has, say, significant pre-existing conditions, maybe diabetes or something, getting an individual plan just for them and then a floater for everyone else, that might actually be smarter. It could help avoid higher overall premiums or specific exclusions impacting the whole family under the floater, For those over 60, there are senior citizen plans. They're specifically designed for age-related issues, though, yeah, they usually come with higher premiums. And if you want an extra layer of protection, critical illness plans. Think of them as add-ons. They give you a lump sum payout if you're diagnosed with certain serious diseases, cancer, heart attack, stroke, things like that. Helps cover costs beyond just hospitalization. Lastly, to really boost your coverage cost effectively beyond a basic policy, look at top-up and super top-up plans. Think of them as like extra financial muscle for those really big expenses. They only kick in after a deductible amount. So that deductible is something you pay yourself or your base policy covers first.
For instance, say you have a 5 lakh base policy and a 5 lakh super top up with a 5 lakh deductible. That top up only starts paying once your total bill goes over 5 lakh in that year. It's smart, yeah, but you absolutely need to understand that trigger point, that deductible.
Exactly, that deductible is absolutely crucial. And speaking of the fine print, what you might still end up paying. Let's really dig into the policy specifics, starting with those, sometimes tricky, waiting periods. Every new policy has what's called an initial waiting period, usually 30 days. It's for general claims, so you can't just buy it today and claim tomorrow for a cold or something. But the critical one, the one most people maybe don't fully grasp the impact of, is the pre-existing conditions waiting period, or PD. This can be anywhere from 2 years, sometimes even up to 4 years. It means conditions you had before you bought the policy, like diabetes, hypertension, thyroid issues, they won't be covered until this period is over. Shorter is definitely better here. And some premium plans, they even offer day one cover for specific conditions now, which is frankly a huge advantage. Okay, next. You absolutely need to understand the inclusions and exclusions, what's in and what's out. So what's typically covered? Things like daycare procedures, that's when you're in the hospital for less than 24 hours for a minor surgery, maybe. Pre and post hospitalization costs are usually covered too, often like 60 days before you go in and maybe 180 days after you get out. Also, AYUSH treatments, yes, that's Ayurveda, yoga, Unani, Siddha, homeopathy, many plans cover those now. Ambulance charges, organ donor expenses, sometimes even home care treatment. But just as important are the exclusions, what's not covered, common ones. Cosmetic surgery, routine dental stuff unless it needs hospitalization, alcohol-related problems, self-inflicted injuries, and pregnancy or childbirth, usually, unless you've bought a specific add-on, which can be quite pricey. You absolutely have to read these carefully. Avoid those awful surprises when you need to make a claim. Now, about the premium and discounts, beyond just comparing the initial cost, which, like we said, is already going down thanks to that GST change, look for ways to cut your premiums even more. Many plans offer a no-claim bonus, or NCB. This usually means your sum insured goes up each year you don't make a claim, but your premium stays the same. It's a great benefit. There are also fitness or wellness-linked discounts. Some plans, like Care Supreme or Aditya Birla Active One, they can offer up to 30% off your renewal premium just for staying active, hitting step counts, things like that. And yes, aggregate deductibles can also lower your premium, but that means you agree to pay a certain amount out of pocket each year before the insurance starts paying anything. So it's a trade-off.
Right. So we're talking about getting the best value. And yeah, good premium is part of that. But I think even more critical than the initial cost is knowing you can actually trust the company, right? When you really need them. So how do we figure that out? How do we gauge reliability? Well, this leads us straight to the claim settlement ratio, or CSR. Honestly, this should be your number one, absolutely non-negotiable check. It's pretty simple. It's the percentage of claims an insurer actually pays out versus the total claims they receive. A higher CSR is better, obviously. 85% plus is good, but really you want to aim for 90% plus. And lots of the top insurers now are hitting 95%, even 100%. A high CSR generally means the insurer is reliable, pays out faster, less hassle. The IRDAI, that's India's insurance regulator, they publish this data every year, so it's verifiable, making it your go-to metric. Then there's the practical side of things. Network hospitals and cashless availability. A large network, ideally say 10,000 hospitals or more across the country. That means easier cashless claims. This is so important.
You absolutely need to check if your local hospitals, the ones you'd actually go to, are included in their network. Because honestly, this can be a lifesaver in an emergency. Imagine not having to scramble for huge amounts of cash during a medical crisis. And finally, you should consider customer service and turnaround time, or TAT. Basically, how quickly do they process claims? This is really where the rubber meets the road, isn't it? For example, Niva Bupa is known for its super-fast 30-minute cashless pre-authorization. Others like Care, HTFC Ergo, Bajaj Allianz, they often process claims within about 24 hours. These quick turnaround times, they signal a smooth, efficient claims process. And that's invaluable when you're already stressed during a medical situation.
Here's where it gets really interesting. And it's where a lot of new buyers honestly get caught off guard. Even if you have a, say, 5 lakh sum insured, you can still face pretty significant out-of-pocket costs. Why? Because of hidden clauses. I'm talking about things like sublimits and co-payments. Sublimits are basically caps on specific types of expenses, even if your total sum insured is much higher. Take room rent sublimit, for example. It's often capped at 1% of your sum insured per day. So on that Euro 5 lakh policy, that's only $5,000 a day for your room. Now, here's the kicker, the surprising bit. If your hospital room actually costs more, say $8,000, you obviously pay the difference, the few thousand. But wait, it gets worse. Sometimes the insurer might then proportionally reduce payments for other associated charges like doctor's fees, nursing charges based on that room rent difference. So your whole bill could escalate quite dramatically. Similarly, ICU charges often have a sublimit too, maybe around 2% of the sum insured per day. And beyond room and ICU, you can find disease or treatment-specific sublimits. These are fixed caps for common procedures like cataract surgery, hernia repair, maybe gallstones. So even if you have a 10 lakh policy, the payout for a cataract surgery might be capped at, say, $40,000 per eye. It's like finding a great deal on a flight, but then realizing luggage fees are extra high. Things like ambulance charges or consumables like gloves, syringes, masks. Sometimes these have limits or they might be excluded altogether. Then you have copayments. This is different. It's a percentage of the total claim amount that you have to pay yourself right from the start. A zero copayment plan is almost always better, less confusing, but yeah, it might come with a slightly higher premium. And let's not forget inflation erosion. It's a slow burn, but that 5 lakh today, it's going to buy you less health care in 5 or 10 years. It's almost like your money shrinks in value. So it's really crucial to review your coverage periodically and likely increase it over time. What this all boils down to for you is this: these seemingly small details. They seriously restrict your effective coverage. They can lead to unexpectedly large out-of-pocket bills, even with insurance. Choosing policies with minimal or ideally no sublimits is really crucial to avoid those nasty financial surprises down the line.
Okay, wow. That's a lot to look out for in the fine print, isn't it? Sublimits, co-payments, proportional deductions really shows why just looking at the sum insured amount isn't nearly enough. So beyond those tricky clauses, are there other, maybe higher level indicators we should be looking at to really gauge an insurer's sort of overall strength and stability?
That's a great question because, a policy is only as good as the company standing behind it, right? Especially for the long haul. One key metric is the solvency ratio. Think of this like the company's financial health check. Does it have enough capital, enough reserves to confidently pay out all its potential future claims? Not just today, but years from now. The regulatory minimum set by IRDAI is 1.5, but generally a solvency ratio above 2.0 is considered very good. It shows the insurer has a strong financial cushion, enough assets to meet its long-term promises. Then there's another ratio, the incurred claim ratio, or ICR. This basically tells you how much the insurer pays out in claims for every, say, 100 hours of premium they collect in a year. Now, there's a sort of sweet spot for ICR, typically between 70% and 90%. If it's too high, like consistently over 100%, it might suggest the insurer isn't collecting enough premium to cover claims, which could signal financial instability long term. On the flip side, if it's too low, say below 50%, that could be a red flag too. It might mean they're being overly strict, maybe reluctant to settle claims, keeping more premium as profit. And this is really important. Always, always verify the latest figures for these ratios: CSR, solvency, ICR on the IRDAI's official website, or reputable comparison platforms like Policy Bazaar or Ditto. Get the most current, reliable data.
Got it. So CSR, solvency ratio, ICR, alongside digging into those sublimits and copays.
Okay, so with all these crucial factors now laid out, knowing what to actually look for, let's talk specifics. Let's spotlight some of the top rated plans out there, especially in that popular 5 lakh to near a range for, say, 2025. We can focus on a couple of standout options and then maybe touch on a few others that consistently get good reviews.
Okay, sounds good. If we dive into a detailed comparison, HDFC ERU Optima Secure really does stand out for several reasons, its unique strengths. Well, first, there's an instant sum insured doubling right from day one. They call it the secure benefit. So your 5 lakh cover effectively becomes 10 lakh immediately for future claims. That's pretty powerful. It also has a 100% restore benefit, meaning if you use up your base sum insured, it gets fully restored for subsequent unrelated claims in the same year. And crucially, there's no capping on room rent or ICU charges, which avoids that proportional deduction issue we discussed. Plus, it covers pre and post hospitalization for a good duration: 60, 180 days, AIUS, air treatments, air ambulance up to 5 lakh, even home care. Add in wellness discounts and a cumulative bonus building up to 100%. It's quite comprehensive. Their claim settlement ratio, very strong at 98.59% for the last reported period, 2024-2025, and approvals are usually quite fast, often within a day. So yeah, this plan is really good for someone looking for that immediate cover expansion, robust restoration features, and a pretty premium set of benefits. Then let's look at Care Supreme from Care Health Insurance. This one also has some really compelling, unique strengths. It boasts unlimited automatic recharge of the sum insured. That means if you claim, the sum insured gets refilled automatically an unlimited number of times in a year for different illnesses. It also has something called cumulative bonus super, which can potentially build your sum insured up by a massive 500% over claim-free years. Imagine turning a 10 lakh policy into a 60 lakh policy over time without paying extra premium for that bonus part. It covers AUS, modern treatments like robotic surgery, offers e-consultations, and has those attractive wellness discounts up to 30% off renewal if you meet fitness goals. And very importantly, it typically comes with no sublimits on room rent, ICU, or specific diseases, and no co-payment clause. That makes it incredibly transparent and predictable in terms of out-of-pocket costs. Care Supreme also has an exceptional 100% claim settlement ratio reported for 2024-2025, and they're known for very fast cashless claim approvals. So this plan, it's excellent, particularly for families maybe, looking for that long-term buildup of cover, great flexibility, and those integrated health and wellness incentives.
Wow. Okay. Those plans, HDFC, Ergo Optimus, Secure, and Care Supreme, they sound incredibly robust. Almost, too good to be true with all those benefits piled on. Are there any particular drawbacks or maybe situations where they might not be the absolute best fit? Perhaps for someone on, let's say, a much tighter budget.
That's a fair point, absolutely. While they are excellent plans, packed with features, especially the ones with no sublimits and those powerful restoration benefits, yes, they will naturally come with a slightly higher premium compared to more basic entry-level plans. So for someone on a really tight budget, they might need to prioritize, right? Maybe they'd have to accept a small co-payment, perhaps on claims for senior citizens in the family, or maybe accept a room rent limit in exchange for a significantly lower upfront cost. Also, while their domestic networks are vast, if extensive international coverage is a primary need, some other specialized plans might be better suited, although plans like Bajaj Allianz HealthGuard do offer global options. So, yeah, while these are top tier in terms of features and reliability, they might not be the absolute cheapest option to just get basic cover. But arguably, they often offer the best value when you consider the comprehensive protection and peace of mind they provide. And it's worth quickly mentioning a few other highly rated plans people often consider in this space. Niva Bupa Reassure 2.0 is very popular, known for its unlimited restoration benefit from the first claim itself. Aditya Birla Active 1 focuses heavily on health rewards, rewarding you for staying healthy. Bajaj Allianz HealthGuard is solid, offering flexibility like global coverage options and different deductible choices. And Star Health Family Health Optima is a long-standing favorite, often noted for including maternity cover options and having a very wide hospital network, especially outside major metros. So each of these offers compelling, unique advantages. It really comes down to comparing them against your specific needs and priorities.
Right, makes sense. It's about finding the best fit for you. And going back to what you said earlier, beyond all the amazing features, how quickly and reliably that insurer pays claims is just paramount. So let's just quickly reiterate the importance of those claim settlement ratios and turnaround times. We saw leaders like Niva Bupa and Care Health both boasting that incredible 100% CSR for 2024-2025. That's phenomenal. Niva Bupa is particularly remarkable with its cashless pre-authorization often done in about 30 minutes. That's incredibly fast. And Care Health typically processes cashless claims well within 24 hours. Others are strong too. HEFC Ergo at 98.59% CSR, usually around 1 day TAT. Bajaj Allianz, 98.54% CSR, also around 1 day. Aditya Birla Health, impressive at 99.01% CSR, often within a few hours TAT. This data really hammers home the point, doesn't it? You should be focusing on high claim ratios and rapid turnaround times. Those should be your main yardsticks, and maybe even more so than just grabbing the absolute lowest premium. Because in an emergency, speed and reliability are what truly matter.
Absolutely. Couldn't agree more. And if we connect all this back to the bigger picture, knowing about these top plans, understanding the metrics, it's a great start. But how do you actually put this into practice? What's your action plan? First, and this is key, purchase early. Younger age almost always means lower premiums and, importantly, shorter waiting periods for things like pre-existing conditions. And now, with that GST reduction coming into effect soon, early also means cheaper than it would have been before September 22nd. So really don't delay. Second, assess your needs first. Really think about it. Your age, your family structure, income, current health status, even the city you live in, these are all crucial factors. A young, single, healthy person has vastly different needs than, say, a family with aging parents and young kids. Third, compare thoroughly. Use those online aggregator platforms, Policy Bazaar, PolicyX, Ditto are popular ones. Use them to compare benefits, features, premiums, and importantly, the claim processes side by side. Don't just glance at the premium, okay? Dive deep into the features and the fine print. Fourth, and I can't stress this enough, read the exclusions carefully. Never, ever skip reading the full policy wording document. It might seem tedious, but you need to be crystal clear on what's not covered to avoid horrible surprises later. Fifth, double check. Ensure your preferred hospitals are impaneled in the insurer's network for cashless benefits. Don't just assume, verify. This is often overlooked until an emergency actually strikes. Sixth, make it a habit. Review your policy annually. Your life changes, your needs change, medical costs definitely change. So review if you need to increase your coverage, maybe add a top up or just renew as is. Seventh, and this is critical for claim settlement, honesty is key. When you fill out that proposal form, be completely, totally honest about your medical history, lifestyle habits, everything they ask. Hiding things can lead to devastating claim rejections later on grounds of non-disclosure. And finally, don't forget the cherry on top, the significant tax benefits. Health insurance premiums are eligible for tax deduction under Section 80D of the Income Tax Act. Currently, that's up to $25,000 for yourself and your family, and you can claim an additional deduction up to $50,000 for premiums paid for your parents.
That's a fantastic action plan. Really comprehensive, covering everything from the timing of the purchase right down to the nitty-gritty of the proposal form and tax benefits. So wrapping this up, what does this all mean for you, the listener, as you navigate this really crucial decision? Well, choosing the best health insurance in India for 2025, it clearly isn't about just finding the single cheapest option available. Not at all. It's about striking a careful balance, a balance between adequate coverage amount, robust features that protect you from those hidden costs, and of course, the insurer's proven reliability, their ability and willingness to pay when you need it most. By understanding these critical aspects, your sum insured needs, the different plan types, those crucial waiting periods, the CKey sublimits, the all-important claim settlement ratios, and now the fantastic impact of zero GST coming soon, you are truly well equipped. You can make an informed decision and really build that personal financial fortress we talked about earlier.
This really raises a final important question, maybe something to mull over. In a world where healthcare costs just keep climbing, seemingly relentlessly, and life constantly throws unexpected curveballs, can you truly afford not to invest in a comprehensive health insurance safety net? Especially now, with the GST exemption arriving soon, that barrier to entry, the cost, is lower than it's ever been. It's a genuinely opportune moment. The real cost, perhaps, isn't just the premium you pay, it's the invaluable peace of mind you gain. Or maybe more starkly, it's the potential financial devastation you manage to avoid. So we really encourage you, use the insights from this deep dive, go compare personalized quotes on those reputable platforms we mentioned. Read the policy documents closely, yes, the whole thing. And seriously consider combining a good base plan with a super top-up plan for even greater, often very cost-effective protection. Don't just buy a policy. Think of it as investing in your future health and your long-term financial security.